Hello and welcome to today's Rystad Energy webinar. My name is David White and I'm a part of the sales and marketing team here at Rystad Energy. Today I have with me Nadia Wigan and Bjørnar Tonhagen, authors of Rystad Energy's Oil Market Trends Report. Our webinars run as part of our free industry insights around E&P, oilfield services, shale and the Norwegian continental shelf. We offer various industry newsletters as well as information sessions, webinars and similar types of events which we invite you to sign up to if you haven't already done so. So keep an eye in your inbox or visit our webpage for upcoming events and for newsletter sign up. It's a pleasure for me to introduce today's speakers. Nadia is Senior Vice President of the Markets team and co-author of the Oil Market Trends Report. She has 10 years of experience in commodity markets analysis and trading from Morgan Stanley and Fibro. Bjørnar is also a Senior Vice President in Rystad Energy's Oil Markets Research team and co-author of the OMT report. He is Rystad Energy's main expert on oil market fundamentals and also responsible for quality checking UCube's liquids production forecasts. Today, we will be discussing the topic OPEC and non-OPEC supply cut scenarios, implications for balances and price. We will now commence with the presentation. On your webinar window, you will find a chat box where you're welcome to raise any questions you may have during or after the course of the webinar. Following the presentation, we will have 5 minutes of Q&A. This presentation will last approximately 25 minutes, and with that, I hand you over to Nadia and Bjørnar.
Hello, starting with today's agenda, we'll go through the oil price and futures curve development, then our outlook for U.S. oil production and global demand growth. Thereafter, we will bring you up to speed on what we believe is the status of production to date for OPEC and the friends of OPEC who have contributed to the production cuts thus far. We will then go through two scenarios, one showing an extension of the OPEC cuts through June 2018 and the second showing an extension of the cuts through December 18. What that means for production and how we view worldwide global balances over the course of 2018 as a result. At the end, we will state what we think OPEC is most likely to do versus what the market would like to see and how we think it will affect price going into next year, and then relay our new base case price strip. So starting with where we are in terms of the Brent futures contract and the WTI futures contract, we have continued to see very strong differentiation between the Brent front month contract and the WTI front month contract. The spread has been quite wide and it continues through the forward curve. The main driver of this, in our view, has been the boom in shale production over the course of this year, which from our perspective will continue to surprise most of the market in terms of how many volumes we'll see coming from the U.S. over the course of this year through next year. At the same time, we have seen very good compliance on a historical level to the OPEC cuts for the group as a whole. We have seen increased backwardation in the forward curve, in the Brent curve in particular, over the last few months. And we have even seen backwardation in WTI following the first few months of trading. This continues through 2020. So looking at our base case view on U.S. oil supply. In this chart, we are showing crude and condensate supply, and we indicate quite a steep increase already in the fourth quarter of this year in terms of our production outlook, going through next year and ending at a high of 11.34 million barrels per day of production in December next year. If we were to compare this production forecast with the EIA's as we did in the last OMT, we would see that the EIA has much lower projections according to the STO. We think there is strong evidence that they are actually under forecasting the production numbers, not least evidenced by yesterday's DOE statistics. We follow the DOE's very closely. We have our own internal model in which we estimate what we think will be a build or a draw each week. And looking at yesterday's surprise build to the market of 1.9 million barrels per day, we can see that if you were to use the DOE's own numbers in terms of the production, you would be at 9.6 million barrels per day. If you were to look at our numbers of production, which put the overall forecast for this month of 9.85 million barrels per day, we can find the difference between a stock build and a stock draw according to their own calculations. Also, in addition, the exports were a bit lower than we had expected at 1.13 million barrels per day. We would expect them to be higher based on trade flows that we are following. Refinery runs continue to be very high at 91% versus a seasonal norm of 88%. This is why we think that exports will continue to be strong through next year. Now, we go over this production profile right now because we maintain this is our base case production profile for next year throughout both scenarios that we show with regard to the OPEC-led agreement. In this forecast, we are looking at $55 WTI, but of course, we have a separate Brent forecast. Looking on the demand side, because we do not see a very strong demand impact as a result of the OPEC extension of the cuts, even though there will be a slight price effect in our view if they were to continue versus not continuing at all. And here we show a renewed oil demand forecast from the third quarter through the end of fourth quarter next year on a quarter by quarter level. So the first thing I'd like to point out is that we actually have increased demand in the third quarter of this year versus our previous forecast, and that is especially driven by changes in China and in India. India has finally realized their previous trajectory of growth in demand at 354,000 barrels per day year on year in September, which makes us more confident in our overall forecast. The first quarter 2018 number continues to be very punchy from us, but our expectation is 642,000 barrels per day. So there is some potential downside risk, but let's remember they had negative year-on-year growth of nearly 100,000 barrels per day in the first quarter of this year. The other number that is driving things higher is Chinese demand that we now forecast for the year at 585,000 barrels per day for 2017. Where we had previously forecast that at 560,000 barrels per day. That is again driven by strong demand numbers in September and October. September of over 1.5 million barrels per day year-on-year growth and nearly 1 million barrels per day of year-on-year growth in October in terms of demand without stock changes. Our 2018 forecast is slightly lower as a result, and we put that at around 300,000 barrels per day. So these are the two main factors to remember are constant in the scenarios we present in terms of OPEC, both on the demand side and U.S. production. Handing over to my colleague Bjørnar.
Yes, so before we have a look at how the two OPEC scenarios would look like, in our view, I think it is worthwhile to have a look at the status of the production for both OPEC and these 10 non-OPEC countries year to date during the current producer agreement. So using our own bottom-up supply data, this is how the total OPEC 14, as we call it, the entire group of 14 countries within OPEC, how the crude production has developed since 2015, including our forecast for the current month of November. And as you can see on the chart here, production has come down from the high levels of the fourth quarter of 2016 when the original producer agreement was made, but compliance for the group as a whole has actually only averaged 52% compared to the around 1.2 million barrels per day of actual production cuts that were agreed to at the November meeting of 2016 in OPEC. So what has caused this somewhat low compliance rate for the group as a whole? Well, the 6 countries in OPEC that are located in the Persian Gulf, those are Saudi Arabia, Iraq, Iran, UAE, Kuwait, and Qatar. They have been pulling their weight, at least, in terms of actually complying with the cuts, and overall for these 6 countries, they have actually produced less than what they agreed to produce during the current producer agreement. And that is led by around 100,000 barrels per day over compliance by Saudi Arabia, also slightly over compliance by the UAE, also helped by maintenance now in the third and fourth quarter, and Kuwait has also complied strongly. Iraq, on the other hand, have not complied as well, and I've also seen slightly slip in compliance, with the exception of just the latest month of October, where the Kirkuk disruptions actually made production drop. However, we do see Iraqi production then rebounding during November now, led by the southern fields. So, and then OPEC as a whole is one thing, but there are also countries within OPEC that are in natural decline, and that has also helped in terms of compliance. The 6 countries that we consider are in actual natural decline, Venezuela, Angola, Algeria, Ecuador, Gabon, and Equatorial Guinea, have actually also complied as such with their targets, but it's mostly led by Venezuela and the accelerated declines we've seen in that country. But overall, that has also contributed to the overall compliance with the target cuts. But the problem for OPEC has been that Libya and Nigeria, that were held outside of the producer agreement due to their production disruptions previously, they have rebounded strongly during 2017, especially Libya, but also Nigeria, as especially exports of avocados during the middle of this year actually rebounded to the market, and exports were opened again. In terms of the scenarios for 2018 and a possible extension of production cuts, we still believe that Nigeria and Libya will be held outside of the agreement, and we also instead include a fixed scenario. That is our base case scenario for both Libya and Nigeria, shown here, where we continue to see a potential recovery in Libya to around 1.1 million barrels per day during 2018, and it could grow even further in 2019 to 1.2 million barrels per day, while we see limited potential for any increases in Nigeria, where the country is struggling with mature field declines and very few field startups. So there we have a slight decline actually from current production levels. So those are kept constant. Then turning over to Russia and the 9 other countries in non-OPEC that are also part of the current agreement. Production to date has also seen fairly strong compliance. That is not only led by Russia, which are now actually complying more or less fully to the production cuts, but also helped by natural declines in many countries, including in Mexico. And just the latest month of September here saw a very large drop in Mexican production due to disruptions. But overall, production is down only 500,000 barrels per day from the elevated levels of fourth quarter last year. So production here is more or less frozen as a result of the current agreement. Then we turn over to the 2 main scenarios we foresee as the most likely options on the table for OPEC now on 30 November. The first one being an extension of the current producer agreement through the month of June next year. So first, we then have a look at, based on our analysis, a potential OPEC production profile, given that the production cuts are only extended through June. In this case, versus our current production forecast in the OMT, we actually reduced the Iraqi production by around 100,000 barrels to be exactly compliant with the production targets that they currently have, which is a cut of 210,000 barrels per day. So that is reducing the Iraqi production. In addition, the UAE is also put at 100% compliance, and also KSA, Saudi Arabia, we continue to see over-complying as they have done so far during 2017 by around 100,000 barrels per day. But then post-June 2018, the countries that are able to increase production, that is mostly the Persian Gulf countries, they will then during the third quarter ramp up production to the field's potentials again. The only exception being Saudi Arabia maintaining some sort of discipline and producing around the current targets in 2019. So that was the OPEC profile. The non-OPEC profile would then also include another 3 months of production restraint by Russia before a production ramp up during third quarter 18. Mexico is continuing to decline. Many of these other countries within non-OPEC, if they are part of the next agreement, will also continue to decline, while Russia will increase its production and be the source of this production growth we foresee from July onwards mostly. So in terms then of total global supply growth in this scenario, we show this chart here. We split global production growth in 2018 and in 19 into 4 categories. It's the OPEC production growth in this scenario. It is the 10 countries within non-OPEC. It is the U.S. oil production forecast, which Nadia showed at the beginning of the presentation. And it's all the countries rest of the world, including all other liquids than oil, including NGLs. Then we see a very strong 2.3 million barrels per day potential supply growth and 2.1 million barrels per day in 2019. But as you can see, it is mostly led by the United States. So what production in the United States will be next year is what will determine the lion's share of production growth, while OPEC is then slightly increasing. And the result for our supply-demand balances, given the demand growth that Nadia showed initially, is then a fairly okay, I would say, market balance for 2018. This year, we foresee that the market is drawing by around 800,000 barrels per day. In this scenario, the production or the supply-demand balance would show a deficit of 370,000 barrels per day. But then in 2019, as production comes back and the United States continues to grow strongly, we see a risk of building of stocks again in 2019. Then the next scenario is an extension through the entire 2018, so through the month of December. In this forecast, basically the same countries that comply with the targets, including Iraq in this scenario, keeps the production target intact through the entire year of 2018. So then in this case, the production from OPEC is not really growing, despite the fact that that Libya production is growing. And then during 2019, production is then ramping up quite strongly if the production cut ends at December 2018. The same goes for the non-OPEC countries, including Russia, complying fully with the production cuts during 2018. And then in 2019, you will see a ramp up of production starting from the first quarter, and it is led by Russia. And in this case, you will see a displacement of supply growth, and production from OPEC will actually not grow at all year on year, essentially meaning a freeze of the total OPEC production volumes from 2016 levels through the year 2018, and actually around a 200,000 barrel per day year on year drop in these 10 countries in non-OPEC if they were to participate in this deal. But the U.S. supply is then growing strongly, and you will have a 2 million barrel per day year-on-year supply increase, mostly led by the United States. So if we look at the balances in this scenario, then you'll have actually 5 quarters in a row starting first quarter 18 with draws in the market. So this is a quite bullish 2018 scenario. But then in 2019, the balances shift again as demand only grows around 1.3 million barrels per day, and you get supply growth back from production cuts. So then I would turn it over again to Nadia to discuss the conclusion we see and the market implications.
Great. So looking at what the market wants, just talking to our clients and reading the media and so forth, we believe that the market would like to see an extension through the end of 2018. And here we are showing the implications for balances in terms of year-on-year growth. So for 2017, as Bjornar mentioned, just over 800,000 barrels per day draws. 2018, around 740,000 barrels per day draw. Again, as he mentioned, 2019, we then see a build of around 500,000 barrels per day. However, we do not think that this is what the market will most likely get on November 30th. Instead, we believe that there will be an extension of the cuts agreed through June 2018 with an open option to extend later, probably another quarter that they would roll it out, and then at some point next year would start to communicate that this is what they are most likely to do. From our perspective, we think that OPEC is starting to get into a situation a bit like quantitative easing, that the market wants them to keep extending and they want to hear either deeper cuts or longer cuts to provide more impetus to flat price to go higher through next year. So next year will still be a drawing year, 370,000 barrels per day year-on-year draws, but still the market wants more. Then we would like to show you our new price forecast for next year. In particular, we raise our Brent price to $60 for our average for 2018, and we have the WTI price at $55 per barrel. We see that Brent WTI spread changing over the course of the year in terms of how we see the profile going into the end of this year, where we still have the Brent base case at $52 for the average for the year. As I mentioned earlier in the presentation, we believe that stocks are drawing overall worldwide, but there is a problem right now in the U.S. in terms of crude stocks. Product draws continue to happen, but the market is reacting to crude stocks not drawing. This is driven by the fact that the expectations of North American shale and U.S. production as a total are too low. So the latest numbers out now indicate to us or confirm again that the EIA is predicting numbers that are too low in terms of production, and other forecasters are also talking about how U.S. shale production will disappoint, and that is driving part of the bullish impetus into next year. We maintain our very strong U.S. shale production forecast, reaching potentially 11.34 million barrels per day in December. Nevertheless, we still see very strong crude stock draws over the course of the year and global liquids draws over the course of the year. So we see some risk to the first quarter price, that the first quarter, although we do see these stock draws coming, that prices will not strengthen necessarily as quickly when the market reacts to this disappointment of the lack of an extension of the OPEC agreement beyond even the 3 months that are already largely priced in. Nevertheless, we see very strong demand growth, and when those numbers are realized, heading into the second quarter, we think we will see strong price reactions. Again, as we go into the third and fourth quarter and into next year, as we see this ramp up in shale and the possibility of a lack of an OPEC cut extension, we see a price risk heading into the fourth quarter in particular, and then affecting our 2019 oil price forecast. And that's why we have that currently at $57 Brent. In 2020, we start to see the true effect of the long cycle, the lack of long-term investments in offshore, FID delays, and so forth, because we've been at a low oil price for a long time. And so that's when we see the oil price jumping up to $67, as that ends up being the resounding effect rather than the shale growth story.
So thanks for listening in, and thanks to both Nadia and Bjornar for this interesting presentation. With this, we will conclude today's webinar. You'll receive an email with a link to request this webinar recording within 24 hours. Once again, thanks for attending.